Most investors think they understand the stock market. They think they can spot trends, predict moves, and avoid disaster. They are dead wrong. The 1929 stock market crash is proof that even the smartest, wealthiest, and most connected people can be blindsided. And by the time they realized what was happening, it was too late. But you sitting here right now are about to see the truth. You're about to discover what history books gloss over and why the mistakes of 1929 still haunt investors today. You probably wonder how it all went so wrong and why billions vanished almost overnight. Stay with me, because what I'm about to reveal will make most investors squirm. The 1920s were called the Roaring Twenties for a reason, and not just because of the jazz, the flappers, or the Model T Fords zooming down every street. Money was flowing everywhere. Stocks were climbing higher than ever before. Ordinary Americans who never thought they'd invest a dime in their lives were pouring their savings into Wall Street. Banks were handing out loans like candy, and brokers were promising that investing on margin was just smart leverage. But here's the thing most people fail to realize. When everyone thinks they're invincible, that's exactly when the system is weakest. And invincible is a dangerous illusion. You probably wonder, how could anyone think this would last forever? Let me show you why they were wrong. Everyone talks about greed being the root of financial disaster. That's true, but it's also a little too simple. The real danger is a combination of greed, overconfidence, and total ignorance. Margin buying, which sounds sophisticated, was in reality a ticking time bomb. Investors could buy 10 times the stock they could afford. And when stock prices started to wobble, those same investors were forced to sell at fire sale prices. They didn't see the warning signs. And the people who should have stopped the madness? Wall Street insiders, bankers, and government regulators. They either didn't act or simply underestimated the magnitude. It's almost laughable if it weren't so tragic. You probably wonder what the first signs were. You won't believe how obvious it all was, and yet how no one wanted to admit it. By the summer of 1929, the market was insane. Stock prices had doubled, tripled, and in some cases quintupled in a single year. Companies with little profit were being valued as if they were tech giants of today. Speculation wasn't just common, it was expected. The newspapers were full of advice like, buy now, get rich tomorrow. Ordinary families, not just the rich elite, were borrowing money to get a slice of the market. Imagine trusting your life savings to a system built on hype, fear, and borrowed money. You probably wonder, did anyone warn them? A few voices did, but they were drowned out by the roar of optimism. And that roar would soon turn into a scream of panic. October 24th, 1929, Black Thursday. It started quietly, like a storm on the horizon. People started selling stocks, but not enough to make headlines. Then panic set in. Brokers couldn't keep up. Phones were ringing off the hook. Traders were sweating bullets as prices began to plummet. It was chaos, and the worst part, most investors didn't even understand why it was happening. And here's the kicker. If you think it was only a problem for the wealthy elite, think again. Middle-class Americans, teachers, clerks, farmers, people who had never set foot on Wall Street, lost everything. You probably wonder, how did it escalate from panic to total collapse? Hold on, because this is where it gets really interesting. By October 29th, 1929, Black Tuesday, the market lost billions in a single day. And when I say billions, I don't mean that casually. I mean fortunes that could have funded entire countries disappeared in hours. Banks were collapsing under the weight of unpaid loans. Businesses shuttered. Ordinary people were lining up outside banks, only to find their life savings gone. And yet, even in the midst of this disaster, some investors were calm. They weren't lucky. They were smart. They saw the warning signs others ignored. Let me show you exactly what they noticed, because understanding it could save you from repeating the same mistakes. The crash didn't happen because of a single factor. It was a perfect storm. Rampant speculation, buying on margin, overproduction, weak banking systems, and a society convinced that wealth was limitless. It's almost poetic in its stupidity. Take overproduction, for example. Factories were churning out more goods than the public could buy. Farmers were producing massive harvests, but they couldn't sell them at a profit. Companies were overextending themselves, and banks were lending without limits. Yet, no one wanted to acknowledge the problem. People were drunk on optimism, convinced the market could never fail. You probably wonder, did anyone try to intervene? They did, but the measures were too little, too late, and sometimes counterproductive. What's fascinating and terrifying is the psychology behind it. Human greed, fear, and herd mentality don't change over time. The same mistakes we saw in 1929 are repeating today in different forms. Investors saw rising prices, assumed they would continue, and bought without questioning fundamentals. The market became a casino. And just like in any casino, the house, or in this case, the system, eventually reclaims its winnings. You probably wonder, could it happen again? History suggests it could, and the lesson is brutal. Ignoring fundamentals for short-term gains is a recipe for disaster. Many people think the Great Depression was caused solely by the crash, but that's only half the story. The crash was the spark, not the fuel. What followed was a collapse of confidence, a chain reaction of bank failures, business bankruptcies, and unemployment. People who had once thought themselves untouchable were suddenly destitute. It's a sobering reminder that financial systems are only as strong as the trust people place in them. Once that trust evaporates, even the largest institutions crumble. You probably wonder, what could have prevented it? There were a few ways, but no one was willing or able to implement them in time. Now, let's talk about margin buying again, because this is where the real arrogance of investors shows itself. People thought they were clever, using borrowed money to increase their returns. But they underestimated the risk. When stock prices fell even slightly, brokers demanded repayment. Investors who had borrowed 10 times what they owned were forced to liquidate at a loss. That's how fortunes evaporated overnight. And here's the kicker. Even those who didn't borrow heavily were dragged down by panic selling. Fear spread faster than any rational analysis. You probably wonder, how did anyone survive this? A few did, but only because they had either cash on hand or the foresight to anticipate the collapse. It's worth noting that government policies played a role too. The Federal Reserve was still relatively new, and its interventions were inconsistent. Some measures were designed to stabilize the system, but others made things worse. Interest rates were manipulated in ways that confused banks and investors alike. The lesson here is clear. Even powerful institutions can fail to prevent disaster if they misread the signs. You probably wonder, why didn't they see it coming? The answer is simple: human hubris. People always overestimate their understanding of complex systems. Let's not forget about the role of media. Newspapers at the time were glorifying the market, reporting daily gains, and encouraging everyone to jump in. Headlines screamed prosperity while quietly ignoring the cracks forming underneath. People trusted these sources, believing the hype instead of questioning the reality. And this is where arrogance becomes fatal, thinking that success is permanent and that warnings are exaggerations. You probably wonder, are we any different today? History would suggest not. Another fascinating aspect is how quickly trust disappeared. Banks, once seen as pillars of stability, were suddenly viewed with suspicion. Depositors rushed to withdraw funds. Bank runs became common, and even financially healthy institutions struggled under the pressure. The entire financial system, which had seemed invincible weeks earlier, was exposed as fragile. And yet, most investors continued to hope for a miracle. They didn't want to believe that their fortunes were gone. You probably wonder, how could people remain so blind? Cognitive dissonance is a powerful force, and it's as relevant today as it was then. By the end of November 1929, the market had lost nearly half of its value. Imagine losing half of everything you own in a matter of weeks. That's not a typo half. And the worst part, this was only the beginning. The repercussions rippled across the globe, triggering recessions, bank failures, and ultimately the Great Depression. It's a stark reminder that financial disasters are rarely isolated events. They cascade, amplify, and punish anyone unprepared. You probably wonder, how did the world recover? Recovery was slow, painful, and required fundamental reforms in banking, regulation, and economic policy. But the lessons from the crash remain timeless. Here's the key takeaway for anyone watching this. Arrogance kills in finance. Overconfidence, blind trust in trends, and ignoring fundamentals are guaranteed ways to lose money. And let's be honest, you probably think you're smarter than the average investor. Most people do, but history has a way of humbling even the smartest. The 1929 stock market crash is proof that no one is immune. Markets can turn on a dime, and when they do, they don't discriminate. You probably wonder, what should you do today? The answer is deceptively simple. Understand the fundamentals, respect risk, and never assume any market is invincible. Some people say, but that was 1929, nothing like that could happen again. That's naive. The same patterns of speculation, greed, and over-leveraging exist in every era. The instruments may change stocks, real estate, crypto but human behavior remains consistent. And human behavior, unchecked, leads to the same results. You probably wonder who survived and why. Those who survived were not lucky. They were disciplined, skeptical, and willing to question the crowd. They didn't follow hype. They didn't buy what everyone else was buying. And that's the lesson every modern investor should take to heart. Let's talk about scale. The crash wiped out billions. Literally. But even more striking is how quickly it happened. Weeks, not years. Days, not months. That's the speed of panic when leverage and speculation meet human fear. And here's the part that makes most people uncomfortable. If you think it can't happen to you, you're already too arrogant to survive it. You probably wonder, what's the moral of the story? Simple. Respect the market, understand risk, and never trust hype over analysis. And finally, remember this. The 1929 stock market crash is more than just history. It's a blueprint for human folly. Every bubble, every crash, every market panic contains the same DNA. Learn from it, study it. And if you ignore it, you will pay the price, just like millions did in 1929. You probably wonder, could it happen again tomorrow? History doesn't lie, and the patterns are unmistakable. The question isn't if it could happen, it's when and whether you'll be ready.